Hey, so welcome back. My name is James Johnson, and my expertise lies in retirement and estate planning. And I'm going to talk to you today about the perfect retirement vehicle. Like, there really is such a thing, a perfect retirement vehicle. It's funny that, whenever I sit down with somebody, the first thing they always ask me is, where should I put my money? Where should I put my money? And it's not as easy as that, because we really need to do an analysis of where you're at, what your needs are, where your wants are, where you're going to be, etc. But once we do that and we figure out, what your time span is and where your money's at, and if you have money that can be repositioned, and if you have any money that you're transferring unknowingly and unnecessarily that could be repositioned, and we start figuring that out, then what we want to start considering is, what is the perfect retirement vehicle? So when we talk about the perfect retirement vehicle, I can assure you that it's going to be very different than what you probably are thinking. So if we start off with the average person out there is doing, the average person believes that the perfect retirement vehicle is a 401k, an IRA, or whatever the case may be. And the reality of that is it's probably not working. Now, if you know anything about taxes, and if you've watched me before and you've learned anything about where tax rates have been and what our national debt is and where tax rates are going, then you're probably pretty concerned about what is going to happen with your 401k or your IRA and whether it really is working. Because the reality of the matter is what you're really doing is you're planning the government's retirement more so than yourself. Now, I know they told you you're going to put money inside of a tax-deferred account and you're going to grow on money you would have otherwise paid in taxes. And in the end, you're going to have more money because you're going to be in a lower tax bracket. But anybody that takes the time to sit down and go through the discovery process and get some clarity about their retirement quickly discovers that in most cases, they will not be in a lower tax bracket when it comes time to retire, despite what they thought to be true. And in addition to that, in many cases, not only are they going to be in the same or higher tax bracket, they find out that taxes are probably going to go up over their lifetime. Now, I'm not here to give you a class on taxes today. We're here to talk about the perfect retirement vehicle. So if you want to know more about that stuff, go watch some of the other videos on, why you should do conversions and all of that other good stuff. So let's talk about the perfect retirement vehicle. We're going to go out, we're going to find the perfect retirement vehicle. Well, I would say that if we were looking for the perfect retirement vehicle, these are the features that we would want. We wouldn't want any risk in it. We'd like to get some guarantees. We wouldn't want any penalties for taking it out early. We would like to have liquidity, use, and control. We'd like to have it protected. We'd like to be able to leverage it, so we'd like to be able to use our money in two places at once. We would like to grow tax deferred. We'd like to be able to take it out tax-free. We'd like to be able to use it for collateral if we could. We'd like to be able to deduct the money that we put inside of it. So in other words, we would get tax deductible payments. We might want some extra benefits, like maybe some disability benefits or some long-term care benefits. And we would like it to pass on in a tax-free manner or the most tax-advantaged manner to our heirs. That'd be perfect, wouldn't it? I mean, what the heck? But, perfect probably doesn't exist. But let's take a look at what we're currently doing out there today. So if we were to look at our IRAs and our 401ks, our most common wealth strategy, we would find that most cases, not all, we have risk inside of our portfolio. And this concerns most people that have these accounts because they're worried about whether they're really going to have enough money when it gets out to retirement. Now, we don't have any guarantees in there, that's pretty much for certain, unless we manage to put that in some type of investment that does. But for the average person that has a 401k or an IRA, they don't have guarantees. There is definitely a penalty for withdrawing early. If we take our money out prior to 59 and a half, we have a 10% penalty plus the taxes for taking it out early. Liquidity, use, and control, well, inside of a 401k or an ERISA plan being a 403b, a 457, a 401k, or 401a, inside of there, we have the possibility of taking out a loan. Now, we can take a loan up to $50,000, but it's really important to understand that if you're going to take a loan from your ERISA plan, you might want to reconsider that thought. Because the downside to taking a loan out of that plan is if you were by some chance to lose your job, you have only 60 days to pay that back, or it's considered a distribution. Now, if you're under 59 and a half and you took out a loan like that, then what would end up happening in that particular case is not only would you have to pay back that loan or consider it a distribution, then you would have to pay a 10% penalty plus taxes at a point where you just lost your job. It's kind of like, double jeopardy, if you will. Now, is it protected? No, it's certainly not protected. Can we leverage our IRA or our 401k? And the answer is absolutely not, okay? Is it tax deferred? Hey, we got a green circle there, or a green box. Is it tax free? No, not tax free. Can we use it for collateral? Absolutely not. The government looks at this money as their money and not your money, so they're not going to allow you to collateralize it, because after all, even though you think you have $1 million in your account, you have a business partner and that portion is his, and so he's not going to let you put that on the chopping block. Is the tax payment, as the payments going in the policy, are those tax deductible? Hey, we've got another green square here, okay? And do we get any other benefits out of it? Disability benefits? Can we pass it on to our heirs the most tax advantage way? Absolutely not. As a matter of fact, when it comes to the money that we pass on to our heirs, the worst possible money that we could pass on to our heirs is our qualified money, our IRAs, 401ks, 403bs, 457, defined benefit plans, etc. Because they're actually subject to two sets of taxes. They're subject to estate taxes if we have an estate tax problem. Right now, for most people, that's not the case. And they're subject to ordinary income taxes. So basically, when we pass these on, we pass them with a bomb inside of them, and it's a tax bomb. And frequently, the people that we're passing them to, because of the distribution rules that they have to take them, end up in a much higher tax bracket than we were, and we end up, once again, planning the government's retirement instead of our own. Now, let's take a look at some of the other investments that we may want to put our money in. And what we would find here is that we have our mutual funds, our home, our certificates of disappointment, our bank accounts, our annuities, etc. Now, real estate, and when you look down through these things, what you see is that there's not a whole lot of green boxes inside of there. So when we're looking for the perfect investment, it's probably not in the things that we're currently doing. Now, if I could go out today and I could get everything green except for two things, there might be some penalties if I took it out early and I couldn't deduct the payments that went inside, then that would be pretty attractive, I would think. And the way I put this all the time is I say, well, look, if you could grow your money tax-free, you could access up to 85% of it at any time tax-free. You could put it back if you want. You could get most of the gains of the market, never participate in the losses, and when you died, it passed on at 2 to 3 times that amount tax-free. Would you want to do something like that? And the answer is generally yes. I would definitely want to do that, and I would want to do as much as I possibly could. Well, despite what you probably think when I'm about to tell you what that is, it is possible to do that. Now, if everything you thought to be true turned out to not be true, how soon would you want to know? So this is the point where you have to dispel your disbeliefs, okay? Put them off to the side for just a second and just realize it is possible that you don't know everything about this subject. And that's obviously why you're here, so you can learn. So what is that? Well, that number one tax minimization vehicle is a properly maximum funded life insurance policy under TEFRA, DEFRA, TAMRA of the tax codes. And once you understand this, if you really, really get it, you're only going to have one question. Why didn't I start doing this a long time ago? Well, when I go out here and I look at what most people call life insurance, and I call death insurance, they typically buy the most amount of insurance using the least amount of money for the purpose of dying. So the way I see it, that's not life insurance, that's death insurance. Yet the insurance companies never call it death insurance. They never call it what it is because no one would buy it. So they put a nice fancy name on it and they call it life insurance. But the reality is when you're buying term insurance, they're never going to sell you that insurance, which is the cheapest way to buy that death insurance. They're never going to sell it to you on a term that you will probably be dead in, okay? You'll probably outlive what the term is. They'll say a 10, 15, 20, 25, 30-year term, but they're definitely not going to sell you a 50 or 60-year term policy because they really don't want to pay you the death benefit. So the fact is only 2% of term insurance policies are ever paid. That's correct. 98% never get paid out. So the second type of insurance that's out there when it comes to what they call life insurance and I call death insurance is permanent insurance. Now the way permanent insurance works is we're going to buy the most amount of insurance. But the difference is rather than putting in the minimum amount of premium, we're going to overfund the policy. And so we're going to keep doing that every year that we have this policy, or we might even build a paid up policy. But the reality is we're going to overfund it. And when we overfund it, it's going to build up a cash value inside of it, and what's called accumulation value and a cash value. And that's going to guarantee us that as the insurance gets more expensive going down the road, then at that point down the road, there'll be enough cash in there to cover those premiums, and our insurance policy is guaranteed out to a set age of 100 or whatever the case may be. So that's a permanent life insurance policy. Now, what I'm talking about is I'm talking about buying a properly maximum funded life insurance policy under TEFRA, DEFRA, TAMRA, 101A, 101C, 7702 of the tax code. Now, when we talk about that, we're talking about whole life, variable life, or index universal life. Now, when we get inside of here, and we're going to just focus on index universal life for right now, what we're going to do now is we're going to buy the least amount of insurance, and we're going to use the most amount of money. Now, this rule here, if you go back to the term insurance, when we buy the most amount of insurance using the least amount of money, that rule is set by the insurance company. So the insurance company says, you give me this amount of money, I'll give you this amount of insurance. When we buy an overfunded policy, we're doing the same thing. We're buying the most amount of insurance, and they'll tell us, okay, how much do you have to overfund this by to make sure it's guaranteed out to whatever life expectancy you want it guaranteed to. But when we buy a properly maximum funded index universal life policy, we're going to buy the least amount of insurance and we're going to use the most amount of money. Now, the difference here is the insurance company doesn't set this rule. This rule is set by the IRS. And this is the point where you should start asking yourself a question. Why is the IRS concerned about how much money I put inside of a life insurance policy? Well, I like to believe because they don't like competition. So the reality here is you get to grow the money tax-free. You get to access it tax-free, put it back if you want, get most of the gains of the market, never participate in losses, and when you die, it passes on tax-free. And what is it they don't get? They don't get any taxes on that money. And so that makes it a pretty dynamic thing when you get right down to it. Now, with an index universal life policy, the death benefit is tax-free. The money's growing tax-deferred inside of it. And when I take it out, I have 3 ways to take money out of a life insurance policy. I had the sad way, the dumb way, and the smart way. And the sad way is very simple. You die, I pass the money on to your heirs, and I will do my best to get your heirs to look sad when I hand them a check for $1 million. The dumb way is a word. I withdraw money. Now, I can withdraw up to my basis, and basis mean the amount of money that I put in the policy. But if I withdraw beyond basis, simply a word, I pay ordinary income taxes. So the smart way to take money out of a life insurance policy is to do what's called a policy loan. Now, the most amazing thing about policy loans is this. I'm not going to borrow my money. I'm going to use my money and I'll leave it in the account where it's at working, getting those gains in the market, not participating in the losses. And I'm going to use that as my collateral capacity to use the insurance company's money. And they're going to give me that in a form of a loan. And the reality of that is that I never have to pay that back unless I bail out or I die, at which point that loan equals out whatever that cash balance is or whatever that death balance is, and the loan is paid off. And it all happened tax-free the whole entire time. So I get a tax-free death benefit. Now, it says here that the main reason why you should buy a life insurance policy is for the death benefit. There's a little bit of truth there, but once you really understand this, the reason why you're doing this is you're building a tax-free bank account. You're becoming the bank. You're learning how to be the bank going forward. The death benefit is basically what I like to call the cherry on top. So if you've ever gone out and you've ever had a strawberry sundae, they put that wonderful ice cream in the bottom down there, and they throw on the strawberries, and then they put on that whipped cream, and they put on nuts, and then they put that damn maraschino cherry right on top. Now, I don't know about you guys, but I take that maraschino cherry and I throw it away, or I give it to somebody else, tie the stem in a knot with my teeth and my tongue, and then I go about eating my strawberry sundae. The way I describe a properly maximum funded life insurance policy is the cherry is the death benefit. I didn't buy it for the death benefit, I bought it for all of the other benefits. In the event of early death, this benefit passes on to your beneficiaries, income tax free, and can be used for anything. Income replacement, supplement to college funding, business succession planning, mortgages and other debts, estate tax coverage, and other financial needs. Now, in addition to that, that money is growing tax deferred inside of there. Your policy cash value has the potential to grow income tax deferred based on positive changes in an external market index. Well, what does that mean? And by the way, it's guaranteed to never decrease based on market volatility. Well, an index would be the S&P 500, the Dow, the NASDAQ, the Barclays, the PIMCO, and the company that we get the policy from will have different indexes, and each year we get to allocate into those. But see, we're not in the market. So what's happening is, let's use the S&P 500 for example, and we say we want to put 100% of our money in the S&P 500. Well, that index will have either a cap, a spread, or a participation rate, or a combination of those things. And then what happens is once we say we want to put this amount of money inside of that index, the insurance company goes out and buys an option to own that index 1 year from your contract date. If the market is up, they execute the option. If the market is down, they let the option expire. And we don't lose any money because we never had any money inside of the market. We can only go with the gains, but those gains will have caps, spreads, and participation rates. You want to know more about that, go look at the Power of Indexing video under our YouTube page here somewhere. Okay? So now, why indexing? Well, because indexing, it refers to the policy cash value, and that's where it's credited. So what happens is we have an accumulation value that credits against that, and we have a cash value. The difference between those two in the first 10 to 12 years is what's called the surrender charge. So the insurance company says, look, we're in this for the long haul, you're in it for the long haul. If you leave early, you're going to help pay for our expenses by paying what's called the surrender charge. My advice to you is this. If you choose to go this direction, understand this is not a short-term plan. This is a plan you're going to do over your lifetime. And you're either going to do it and do it all the way, or don't do it at all. You're either buying properly maximum funded life insurance policy, or you're buying death insurance. And if you make the decision between those two, you should know exactly how it works. So rather than earning a fixed rate of interest like a traditional universal policy or a whole life policy, an IUL grows linked to a performance of the S&P 500, NASDAQ, whatever the case may be. When the index performs well, the policy value increases by the percentage subject to the certain caps, floors, etc. Remembering that we always have a floor of 0. Now, here's what I believe. I believe it's more important to avoid the losses than to pick the winners. I always laugh when people say, well, my average rate of return is X. Well, if you've heard me talk before, you know that average rates of return are a lie. Because if there is 1 0 in the year they're calculating, the average rate of return is not true. Yet, when we're using an index universal life policy, I said 1 0, anything below a 0, so 1 negative year. Inside an index universal life policy, we'll only have zeros. We'll have zeros or gains. There will be no negative numbers inside of there, so our averages will be pretty good. Now, keep in mind that it's never about what the average rate of return is. It's about the net at the end of the day. And when we do the calculations based on that policy over time and we compare it to other investments, we find that because we're growing our money tax-free and accessing our money tax-free and getting really good averages of rate returns over time, we outperform most other investments quite well. And then in addition to that, we always have that death benefit and or other benefits such as disability or long-term care built into those policies. So what is the power of indexing? So if we look at this chart, this one only goes from about 2000 to 2017. But you can see here what the market did. For 2000, 2001, 2002, the market went down. And then we went up for 5 years. We got ourselves back up to where we were. Then 2008, the market went down again. And then we had this long run up in the market. We had a 10-year run up inside of the marketplace. Now, if we looked at what happened under indexing, we took zeros during those first 3 years, and we took zeros during 2008. So while the other person was over here putting their money in the market and losing money and then having to recover off of that loss, we recovered from where we stopped. Okay, so wherever we stopped, we didn't have to go back and gain our money back. And in this case, we came out at 352, 271, and they came out at 181 based on market performance. So right there are those 2 zeros that we took inside of there. And by the way, right now it's February of 2023. And it wasn't too long, about almost a year ago, it was in March of last year, we had quite a downturn in the market, and it hasn't been very good since. How would you have liked to have gotten 0 in the last year? Would have been a hell of a year, wouldn't it? So tax-free distributions. Now, your loans from your policy cash value are income tax-free. They don't even show up on your tax return. So they have no influence on your Medicare, they have no influence on your Social Security or any of your other things, and they allow you to do a bunch of tax planning to get your other items down and get you to a lower tax bracket. Distributions can be used for anything: supplemental retirement funding, long-term care needs, college tuitions, weddings, vacations, credit cards, financial emergencies, buying cars, buying houses. There's no end to it. And the insurance company is not going to ask you what you need the money for. They're simply going to give you the money very quickly, directly into your account, no questions asked. So, how does this stuff work and why does it work? Well, because it works under the tax laws. So it's 101A is the IRC section, and life insurance benefit received is federally income tax free. This has been this way for a very long time and not likely to change anytime soon. 7702 is the definition of life insurance provides tax-free growth. So all money that grows in a life insurance policy is tax-free. 72E says taking loans from a policy are not considered distribution and thus generally not subject to income taxes. Now, there would be only one time they'd be subject to income taxes, and that's if you did something stupid like cash your whole entire policy in at some point. Then those loans could possibly become tax-free, but as long as you are doing it under death or free withdrawals and or loans, you have no problems with regards to taxes, unless your free withdrawals exceed your basis. Ed Slott. Ed Slott says the single biggest tax code benefit in the tax code is the tax exemption for life insurance. Now, you may not know who Ed Slott is, but Ed's a pretty funny guy. He calls himself a recovering accountant. And he is the number one source in the United States for qualified money. IRAs, 401ks, 403bs, 457s, Roth IRAs, anything to do with qualified money. Ed's a pretty smart guy. Now, I was a master elite advisor for Ed Slott for more than 9 years. I only quit because it was the same information over and over and over again, and I just got tired of learning the same stuff again and again. But I have a lot of respect for this man. He's got some really good ideas with regards to things, and when it comes to life insurance, it is his number one tool for building retirement going forward. Is it right for you? Well, I always laugh when people come in and the very first thing they say to me is, should I put my money in life insurance? Should I put it in annuities? Where should I put my money, etc.? I have no idea. Okay, I really no idea. If you walked into your doctor's office for the very first time, you've never met the doctor before in your entire life, and as you walk through the door, the very first thing he did is hand you a pill and say, eat this pill, would you eat it? And the answer is absolutely not. And the reason why is because he's done no diagnosis. He doesn't know who you are, what you might be allergic to, etc., and he's already prescribing you pills. That's called malpractice. And for me to tell you that this is right for you, or anybody to tell you that this is right for you, until they sit down and do a full analysis of where you're at and figure out where you're at, what your goals are, where you're going, and whether your time frame fits into this kind of a strategy, well, it would be crazy to say it's right for you. However, it very well may be. Now, if you're young and you're down in your 20s, 30s, 40s, even your 50s, it's almost a no-brainer. You should probably be doing this. As you get farther up in years and get closer to retirement, it becomes questionable whether it's good or not. But there are times that it makes a lot of sense. Even right up into your 70s, it makes a lot of sense depending upon what your goals are. So, what I would encourage you to do is I would encourage you to reach out. Take the time to sit down and I'll do a plan for you and I'll show you where you are in retirement. I'll give you more clarity about your retirement than you've ever had before in your life. I'll answer those four most important questions that your financial planner should have been answering for you up to this point. One, what rate of return do I need to make on my money to live the lifestyle I've become accustomed to, adjusted for inflation and taxes, out beyond my life expectancy? Two, how much money do I have to save based on those same parameters? Three, how long will I have to work based on those same parameters? And the worst one of all, and that is, at what point, will I have to cut my income to not run out of money? And that's a really bad retirement plan. So be sure to take the time to set up a time to get together with us. You can reach out to us by phone, by email, by Calendly. There's several ways to do it. Go out here and watch some more videos, and let's get some clarity going for you. So remember, live like you're going to die tomorrow and plan like you're going to live forever, because you just might. Keep smiling, and I'll see you next time.